Good morning, everyone. My name's Hannah Brenton. I'm a financial services reporter at Politico, and I'd like to welcome you to the 6th edition of Politico's Finance Summit. We're thrilled to have the opportunity to host this summit virtually and hope you enjoy the conversations that will take place throughout the day. We're convening top global thinkers and influencers to discuss and focus on the most pressing issues facing the finance sector and shaping Europe's financial future at a time when the continent finds itself in the throes of a historic recovery. Through today's 12 sessions, we will deep dive into crucial topics for your sector with interactive interviews, panel discussions, and spotlight conversations to discuss Europe's green recovery, sustainable finance, capital markets union, banking union, to mention but a few. I'd like to particularly thank our speakers for agreeing to share their expertise. I'd also like to thank our presenting partners, Generali, LSEG, and MasterCard, and our supporting organisation, ICI Global, for making this event possible. Before we begin, I'd also like to mention a few housekeeping rules. You can ask questions and answer our polls only through our Swapcard app, the instructions for which you can find on our event website. If you're already on the app, you can chat with fellow attendees and ask questions in the chat box. That's to the right of the screen if you're on desktop, and below the live stream if you're viewing on your mobile. You will also have the opportunity to answer polls at the beginning of each panel discussion. We want to make this event as interactive as possible, so please don't hesitate to tweet about this event with the hashtag PoliticoFS. Now, I'd like to kick off this year's Finance Summit by introducing Mairead McGuinness, EU Commissioner for Financial Services. Good morning, Mairead.
Very good morning, Hannah. Delighted to be with you.
Thank you for joining us. So I'd like to begin with a couple of questions on Brexit. You're in the process of negotiating a memorandum of understanding with the UK. So could you give us a sense of how that's going and if you're on track to agree it this month in March?
Well, as you know, there was an agreement in the trade and cooperation deal, which was reached at the end of last year, that we would, on financial services, agree a memorandum of understanding with the United Kingdom. So work is ongoing at a technical level. We were able in recent days to exchange draft texts. So we've given our draft to the UK and in return have received theirs. And again, at technical level, we are looking at the two texts and trying to work towards achieving our agreement, if you like, by the end of March. So at this stage, I would be hopeful that we can do that, because essentially the memorandum of understanding is about how we will cooperate and work effectively as partners, the EU being outside of the European Union. We need to have a good relationship. We have a similar arrangement with the United States, and they're not as physically close to us, but twice a year we have a very good forum with our US counterparts. And we would hope that a similar structure would develop with the United Kingdom. But the first step, of course, is to get the memorandum of understanding agreed. And certainly we are working towards achieving it by the deadline that has been set. And then afterwards, we will have to look at specific points. So I suppose Brexit for the financial services industry, particularly in the United Kingdom, was quite a fragmenting process because, as you know, financial services were not part of the discussions that were led by Michel Barnier. And therefore, there was significant change for financial services from the United Kingdom on January the 1st. From our side, what has been really important, and it was very important in the run-up to January the 1st, was that we looked carefully at how our financial system was and were there decisions we needed to take around financial stability. And we took two of those because there were concerns around two particular areas of the financial system. And we did an equivalence decision in relation to those. So it was really important that on January the 1st, there was no disruption. And that is down to the good work of national supervisors and indeed the work here in the Commission. But look, we're in a different phase now. We're in the phase of developing a relationship with the United Kingdom, a workable relationship where we will need to discuss lots of issues, particularly like you're discussing today. So we're on track.
Okay, and you mentioned the equivalence decisions. You've said before that it's unlikely the EU will have a kind of body of equivalence, ready to go once that memorandum of understanding is in place. But can you explain what kind of timetable you might be working to after the memorandum?
Well, I think it's really important to say that, lest there be any doubt, that when we sit down with the United Kingdom following an agreement on the memorandum, it is not to do a package deal within a short space of time, which might recreate access to the single market for the United Kingdom. So therefore, there isn't, if you like, a bundle of equivalence possibilities that are suddenly on the table, to use a phrase, that are oven ready. We will rather look at each one as it requires us to do so, particularly where they are of interest to the European Union. The UK has taken the same approach when they granted equivalence on some issues prior to the end of the transition period. So I think when it comes to financial services, we are not under the same pressure. We are not under an obligation to have an all-encompassing agreement, because we now respect that the United Kingdom is outside of the European Union and will make its own decisions. And indeed, the European Union will equally make decisions in its best interests. I was trying to catch up on yesterday's budget announcement from the Chancellor of the Exchequer in the United Kingdom. There is some, I think, talk around regulatory changes within the financial system. Clearly, anything like that would feed into our decision making. And we did, issue a number of questions to the UK authorities some time back. We've got lots of information, but there are still gaps in that information. And indeed, what we have to make sure is that if we grant equivalence, that it is future proof. But equivalence is not the same as the single market. And I think both of us know that. Again, to repeat very clearly, from our side in the European Union, we will make decisions that are in the best interests of the European Union, its financial system and financial stability. And the consequences of Brexit for the financial system flow because the UK has chosen to be a third country, and indeed to remove itself from the single market and, of course, the customs union when it comes to goods.
You've made it very clear that divergence is the issue when it comes to equivalence. But in that sense, if the UK is not planning to diverge in a specific area of financial services, can we presume that they would be granted equivalence at that point?
I suppose there are lots of ifs, buts, and ands in your question, and I see where you're trying to go with this. I suppose I have to be more cautious and to stand back. As I said yesterday in the budget speech, and I'm trying to quote the line, the Chancellor spoke of an overhaul of the regulatory regime to breathe new life into London as a global financial centre post-Brexit. That's quite a big statement. I'm sure there's a lot behind it, but clearly what that says to me, who has responsibility for financial stability, is that we are, if you like, unclear as to what regulatory changes will occur. And I've always made the point many times that, it is not possible to have equivalence with divergence. So in other words, we have to be really cautious around the future plans of the United Kingdom. Perhaps they are only working out their strategy now that they are outside the EU. So again, I think the idea of, look, if there's no change, what will you do? I mean, it's a conversation piece, but I can't base a decision on what we think might happen. I have to be very clear with market players, because this is a sensitive area. We need to be clear, and have been consistently clear, how we will approach this. And we've been very clear with the United Kingdom as well. And equally, the UK has said, indeed just yesterday, about their intentions. What those intentions, if you like, transfer into in terms of real action that might impact on the financial system, we're not clear yet. So again, to repeat the point, that equivalence is not about recreating the single market access. The United Kingdom lost that because of the form of Brexit they chose. And therefore, we will be looking at each particular element where we see an advantage or a need for us to take action. And I dare say the UK will continue in that same vein. However, and I think this is really important, the United Kingdom has not moved physically, so it is still very close to the European Union. London, as a big financial centre, was part of the European Union's financial infrastructure, but now it is outside of the European Union. And therefore, we are being very clear that we need to analyse what that means for our financial system and financial stability. And we need to take action where that is appropriate for us to be able to continue to function effectively and to give proper messages to the marketplace. But we do need a strong relationship with the United Kingdom because there will be global issues, sustainable finance, anti-money laundering. All of these things require us to talk to our global partners, whether it's the US or the UK. So, there are possibly some difficult issues we will need to deal with around specific points, but we also need and will have, I believe, a good and strong relationship with the United Kingdom. I think that's essential.
Do you fear this kind of Singapore on Thames, deregulatory London on the edge of the EU then?
Well, I suppose I've said only recently in the European Parliament that I am not a light touch commissioner. I think we learned from the past that light touch regulation caused huge harm and problems, both financially and to our society. As to what I fear, what I think I need to be very clear on, as opposed to having fear or otherwise, is that we as the European Union, we've learned from bitter experience. Look, in this crisis, our banks were so well regulated that they were able to help and continue to help businesses and citizens by lending money because we regulated, and we realized that after the last financial crisis, we were not regulating the financial system appropriately. I hope that other players, including the UK, understand that. I believe they do. I wouldn't like to see the United Kingdom ripping up regulation, and I think we wouldn't be the only global partner that would be concerned about that, because even if you look at the evolution of digital and fintech and currencies going digital, while we talk about our own area of competence here in the European Union, all of these developments are global and have an impact globally. So I think that we need to be very cautious about the idea of unpicking regulation. Equally, while I'm not in favour of light touch regulation, I think we should always, even within the European Union, look and have appropriate and effective regulation. Because I talk to a lot of stakeholders in the financial system who would say that parts of our regulatory framework, whether it's in insurance or banking, or indeed in investment products, can cause some problems. So we are open to looking at those issues and finding internal solutions where we believe it is appropriate. But we're certainly very clear that we've learned from past mistakes and we're not going to go back there again. But to your point, I hope that the United Kingdom, who also I think as a country learned from past mistakes, will not revert to a place where there was very light touch regulation and where in fact that had very damaging impacts on citizens and society.
Okay. And one other thing I wanted to ask on Brexit was there is criticism in London of the EU's approach to equivalence. What do you say to some of those comments that this isn't a serious process? This is about kind of grabbing market share from London while these kind of hold over.
Yeah, I would be surprised by that remark because I think the UK understand very well that the decision they made on Brexit and the form of Brexit, anything that has happened since then, and presumably you're referring to shared trading moving, for example, to Amsterdam, that was just the inevitable consequences of Brexit. So I think that the UK understand that very well. I mean, I've read and listened to comments, but I rarely react to them because I think it's not appropriate. We have to be firm from an EU perspective and very clear with our UK counterparts as to what we want to do. And I think we have been. I'm also looking forward to a meeting which is scheduled with the Governor of the Bank of England, Andrew Bailey. And I think that's also important in terms of building relationships. But clearly, I think the City of London and I think the United Kingdom, they are probably concerned about losing any business. But clearly, they must have understood, at least they do now, that Brexit would inevitably lead to some loss of business because the passporting was gone. So the firms in the United Kingdom couldn't do business for UK clients because of the very form of Brexit they have taken. So again, to the commentary around the financial services, there are lots and varied comments. My job is to make sure that I look after the core interests of the European Union in a very globalized financial system, and that I develop a strong working relationship with my UK counterparts where we can, as trusted friends and negotiators, navigate a future which is an uncertain one. I should add, and you will be aware, that a development yesterday, for example, in relation to the protocol on Northern Ireland, where the UK took a unilateral decision to decide to extend grace periods, things like that don't help build trust. So we've been here before where the United Kingdom, pulled, if you like, away from an international agreement by putting legislation on on the books through the UK Parliament. We're dealing with yesterday's events, which have consequences beyond the specifics, but clearly in terms of trust, they cause some difficulties. And I can only speculate how member states feel about this, and I dare say we will hear more of that, but also how the European Parliament, where I came from quite recently, how the European Parliament will react at a time when they are looking at ratifying the Trade and Cooperation Agreement. So I suppose everything about Brexit since 2016, has been difficult. That was inevitable because it is a first. It's a very fragmenting event where a member was pulling away from a system that worked very effectively and efficiently as the EU 28. But the UK had made a decision, which we fully respect, but the consequences flow from that, and they also impact on London as a financial centre.
One of the consequences of moving business within the EU is this fragmentation. I just wondered, if financial firms pay higher costs within the EU as a result, is that a price worth paying to have that move from London?
Yeah, again, we have to look at that, and we will be conscious that we do not want to overburden business. We want the financial system to be efficient and effective. I suppose there's a price of everything, and then there's a value. And I think the value that we will be looking at is part of our whole value system, where we will want to make sure that our financial system is strong, resilient, that we are not, if you like, being controlled outside of our zone by a third country, and that where we have a relationship with the United Kingdom as a third country, that it is a good and effective one and works in our interests. There are issues around, you used the word fragmentation. I think given COVID, it's been quite interesting that if you look at what has happened across society since this awful pandemic hit our shores over a year ago, businesses have exited centres and workers have gone back to all corners of Europe and beyond. And in a sense, this is a new normal. So the idea of having one financial centre, certainly that is the London approach, that we have strength in being physically present and there. I don't think it's as valid for the future as the past. And I mentioned developments around the whole digital space. So I don't think fragmentation has, I suppose, a connotation of being negative. But equally, there are very strong capitals across the European Union that have strengths in different areas of the financial system. And I think all of those will play to their strengths. And I think equally, the financial systems, the banks, the institutions, they know what they need to do in terms of, if you like, looking after their EU customers. But we are aware of all of these things. We do not go into this discussion or these processes without being aware of consequences, both good and bad. And therefore, we will take a very holistic approach when we're looking at equivalence decisions and other areas where we will need to cooperate with the United Kingdom.
You've mentioned the EU's capital markets there, and the big capital markets union project. In the context of the coronavirus pandemic and the recovery, is that progressing quickly enough?
Well, look, I would say no. I would rather we had a stronger capital markets union years ago rather than still be working on it. But look, capital markets union was always going to be a step-by-step approach, and it still is. Again, I think the pandemic and this recovery, which you will be discussing in detail today, would require us to have deeper, more liquid capital markets so that businesses and entrepreneurs have access to different sources of financing. And this is what it's all about, making it money more available for good purpose. Because if you look at the United States, how it came out of the last crisis quicker because they have these stronger capital markets. Now, we can't just mimic what the United States has, but we want to have the same benefits of having a strong capital markets union. And to some extent, it is the other side of the coin around banking union. In my view, they go hand in hand. So I think COVID is certainly a wake-up call to us all to try and advance and accelerate. Clearly, across member states, there are some differences. There are some difficulties even within member states on issues around insolvency and withholding tax. They're tricky and difficult to try and make progress on. On the other hand, I think we have to deal with all of of them in turn. So from my side, and I've been mandated to advance the Capital Markets Union, I have done a lot of work already trying to get to grips with where we might make more progress. And in my conversations, I have not met anyone who thinks the Capital Markets Union is a bad idea. What I have met are some stakeholders who want it, but have concerns about it. So I think we need to work really well with the European Parliament, with the Econ Committee, with member states in the Council to advance how advantageous strong capital markets would be from an EU perspective. And I think that speaks also to the idea of open strategic autonomy, of a more multipolar world, of Europe realizing that we have to get stronger internally in order to have a stronger voice globally. So in a way, all of these pieces, if you like, of the jigsaw are coming together, I think in an accelerated form because of the pandemic. I mentioned technology. I mean, how accelerated has that transformation been? You can see banks restructuring their entire operations. Equally on the capital market side, we can make progress here. And I'm not daunted by it. I think that it is in this way of making the small steps, but getting there eventually. And I think I certainly will leave no stone unturned to make progress on CMU.
One of the big thorny issues in Capital Markets Union has been supervision. And during the pandemic, we have seen more calls from some authorities for greater sort of EU powers and centralisation. The Commission's due to come up with some kind of proposal by the end of the year. How are there areas where there could be more powers passed to the centre?
I think in all of these conversations, when it comes to creating and developing single market, if it's in capital, as we're discussing, there comes a point where there is a realization of the need for more European supervision. And I think that's an important part of the process. It's happening also when it comes to anti-money laundering work that is ongoing here in the Commission as well, where member states obviously do their own work in their financial investigation units, but now there's a realization that that's not enough. We need more coordination. We need more European supervision. So we in the Commission are looking at all of the possibilities and how we might manage to do that. And we have to do it with the member states and the European Parliament on board. But again, I would just repeat the point that on both Banking Union and Capital Markets Union, there are clear commitments politically that these are important for the European Union for the future. What is difficult is to try and unpick some of the political problems within member states. And we have to respect that they are real while making progress. And that just involves a lot of discussion, making, I suppose, some progress and then having to wait until others are able to come on board. For example, in Banking Union, home host issues and the whole sovereign nexus. I mean, these are difficult issues in Banking Union. There are similar problems around the Capital Markets Union. But everything in the European Union, and I've been involved in EU politics for some time and would have been a very engaged previous to that. Things are proposed and it might take time for it to happen. But once they're on the table, they do eventually come to pass. And I would hope that given what we're going through now, which is still a pandemic, but towards a recovery, that there would be a real political push to say, well, let's unlock the difficulties in the Capital Markets Union, the Banking Union, other areas around European supervision, so that we get the best for our companies, for our citizens, for job creation. And the focus here in the Commission is very much on that, on jobs, because we know that, for example, young people have been particularly badly affected by this pandemic, and not for the first time a young generation has taken a hit. So we're looking at all of the financial system needs to support a new future, which is a future that is more resilient, more green, because we will be working towards our Green Deal, our climate targets, biodiversity and environmental issues, and young people want that, but also digital. So I think it's a time of both great opportunity and, to use that word, challenge, but I think the opportunities outweigh the difficulties that we might face along that path. So I think I'm 6 months in this role, thereabouts, and when you look at all of the problems that face us, you could be, if you like, quite daunted by it all. But in fact, when you see the opportunities of the European Union having a strong capital markets and having banking union effective, they would be quite momentous. And I think they are really possible and they are within reach.
We do have direct supervision of banks at an EU level. Do you think there is a political opportunity to create that kind of direct supervision for large asset managers or large insurers?
Well, look, we're having discussions around how we would reform in the areas of both asset management and insurance, Solvency II, for example. So I think we will look at all of this. We are looking through stakeholder dialogue and consultations. And when we make proposals, we don't go into the process with a fixed mind as to what we could do. So all of these things are on the table, and we will make a decision based on our exchanges, the feedback we get, and what we think is appropriate. And of course, then the Parliament also and Council will be directly involved. But to the point on European supervision, what's very clear is that where we have strong supervision, like the banking area that I referenced earlier, we know it worked. It really, really worked. In fact, the true test of the work done on banking supervision and regulation has been this crisis, because we had a banking system that, despite the turbulence caused by COVID, was resilient in difficult times. And I think that should really encourage us to look at that model for other areas of the financial system.
ESMA wrote to the Commission yesterday on wirecard and some potential fixes there to financial reporting. Will you take those into consideration, and are you bringing forward anything else related to wirecard?
Well, I think when ESMA writes to us with recommendations, we take it very seriously, because they're an important part of our process in terms of legislation. I mean, let me reflect on wirecard. I think from outside looking towards this crisis, and it is a major crisis which has impacted so many, there were alarm bells ringing. Prior to the crisis, if you like, hitting. And I think it is something we need to understand, that why were the alarm bells not heeded? Were the ears of the supervisors, the regulators, not tuned in to what was being discussed through media, for example? And I think we do need to understand why that was the case. And clearly in Germany itself, there's a lot of work going on to try and understand, as there is within the Commission, that what happened in Wirecard, when and how, because we will definitely be open to saying that if our legal framework allowed any of this to happen, then we need to change elements within it. ESMA have made their recommendations, and I think ESMA were very rapid in reacting to the Wirecard situation with their initial report. But clearly, events like Wirecard cause instability and uncertainty, and should make us all very anxious about potential repetition of these types of crises, which impact so badly. So we need a very forensic look at Wirecard in all its different stages. We clearly need that regulators are tuned in to what is happening on the ground. And as I say, it is quite extraordinary that all of those noises which were raising alerts seemed to go unheeded. And I think that, in the member states, this is a lesson for everybody, to be very clear that if something is being talked about, that it may not just be somebody's opinion, that it needs to be looked at before a problem arises, rather than waiting till after a really serious problem happens. And I think when there's a problem in the financial system, when there are activities that are inappropriate, we have to find out the reasons why. And clearly the whole audit function is also under scrutiny and review, as it should be, because there are many examples in recent days of where, reputable firms were fined by their national supervisor significant sums of money for inappropriate behavior. So it can still happen, and it can happen in reputable firms, or maybe I should say so-called. So I think we have to be tuned into that. And always mindful that when a problem arises in one member state, in one particular part of the financial system, it has consequences elsewhere. And that's why we're very open to listening clearly to what ESMA has to say and taking the appropriate action once we have the full picture.
Moving on to the green finance agenda a little bit, we have a number of pieces of legislation coming forward. There's the debate on the taxonomy, the broader renewed sustainable finance strategy, eco-labels, the EU Green Bond Framework, various disclosures. Can you explain how that all fits together?
Well, in fact, that would be my opening remark to you. This needs to fit together. And I think one of the things that we're looking at here is to make sure that we are moving towards this sustainable finance, so reorienting finance towards activities and sectors that are sustainable and also in transition. But we need to do that in a way which isn't burdensome for businesses or for SMEs. So let me take the taxonomy, because obviously it is the hot topic of the moment, and we're working night and day in terms of the draft delegated acts, which are very important in specifying in a science-based way what are sustainable activities. But equally important, we need to talk about elements that are in transition. And we also know that within the taxonomy, there will be reporting requirements for some businesses, particularly the larger ones. But there is also likely to be a ripple effect. And let me just explain that the taxonomy is voluntary. And I keep repeating this point. So it's not mandating investors or indeed companies to do anything, but it is likely to be an enabler of change. And the truth is, we know the destination of our policies today. It is climate neutrality by 2050. More, if you like, strict emission reduction targets in less than 10 years. And that requires us all, everyone, society and individual activities and sectors from construction to energy to land use, to undergo quite a dramatic change. And the taxonomy is, in my view, a guide, a roadmap to that. When you talk about non-financial reporting, what we have at the moment is quite, it's there, but it's not effective. So we will be looking at mandatory non-financial reporting for particular businesses. We are still discussing the scope, how wide that might be or otherwise. And the intention in time is that we would have financial reporting and non-financial reporting on a par, so that one isn't above the other, because clearly we know that businesses and enterprises have impacts externally on climate, environment and other issues, some of them positive, some not positive, and equally climate and environmental issues impact businesses and their financial stability. So in a sense, what we are trying to do is develop a package of legislative measures which allow us understand what's happening around our targets, give businesses signposts and ways of reporting, allow investors to see what companies are doing things in an environmentally or climate friendly way that the investor might want to be involved in. And what's I think really significant is that asset managers, very large asset managers and indeed pension funds, are now putting sustainability at the very core of what they do. That is quite a significant leap forward. Some years ago, all of these things were nice to talk about. They were nice to have in an annual report. I think now we're talking about putting action on words. And this is the difficult part of the conversation, but you've listed many elements there. And if you look at it, coldly, you would say this is a lot of legislation, and it clearly is, but each of them has to have a defined purpose, has to be effective. And when I speak to the services here, I make this point repeatedly, but all of it has to work together to allow us in the financial system here within the Commission to achieve our climate and our targets around environment and biodiversity. I think it's also interesting that DG FISMA, which is about financial stability, is really at the core now of this transformation of our society and our economy, working with other colleagues in DG Klima, Environment, in Agriculture, and across the House here in the Commission. And I think the message is that if the money is not encouraged to flow towards sustainability, we will be in a very difficult place. We will not achieve our targets, and I think there will be a generation of young people who will never forgive us. So we can't fail on this, and that's why, to your very point about the basket of measures you've just referenced, they have to be effective towards achieving our goal. And equally, we are always open to reviewing, and indeed have done that on occasions in the past. So when I speak to businesses, I make this point. I also hear them, because Business Europe have said they are anxious in a time of pandemic and recovery about what might be coming their way. So we have to work with stakeholders, whether they are environmental organizations or the business community, to make sure that we bring people on board, because if we alienate any section of society, then we will not make the progress that needs to be made.
Just very quickly, because we're running out of time, but given that the non-financial reporting framework isn't in place yet, is there a risk that you're trying to ask the financial sector to kind of run before it can walk without that information available to it?
I'm going to use a running term. I think the financial sector has started jogging. I think that they know what's coming down the tracks. I think the taxonomy regulation was a very clear indicator. So while they might be concerned about having more details, which will come relatively soon, I think they are gearing up for this significant change. So while I hear some concerns, I also understand that when I talk to the financial system, already banks are looking at the taxonomy as to how they will report what elements of their business is taxonomy compliant. So look, I think there will, as I said, the jog has started. I think we're going to go into a sprint, and I think this is a marathon, and it will be done at speed.
Thank you very much, Commissioner. That's a very interesting end to the debate. Thank you so much for taking the time.
Well, thank you, Hannah, and good luck with the rest of today's really interesting conference.
Thank you. So the next session is a joint interview featuring Mario Centeno, Governor of Banco de Portugal, and Klaas Knot, Governor of the Central Bank of Netherlands and Vice Chair of the Financial Stability Board, starting at 9:10 with my colleague Johanna Trek. So stay tuned.